Hi, this is Jim Cunningham, and I have today with me Phil Wilson and Greg Elias. We're going to talk about the Employee Retention Tax Credit, how to get it, and how to mitigate the tax bill that is associated with it. Even though the Employee Retention Tax Credit is not technically taxable, it does kind of alter, it warps the tax universe to cause more taxes to be due. So if you got it, great. If you haven't gotten it and you're a business owner, you really do need to take a look at this. And as we go through the materials here, both Phil and Greg are really gonna, and I will talk about, hey, this really does work for a lot of people. And we were talking before we got started here that many people have not claimed it that otherwise, could legitimately claim it. It's up to $26,000 per qualified employee. And we'll talk about how you get it. Greg's going to cover how you get the Employee Retention Tax Credit. And then Phil and I will talk about, and Greg will talk about what tax strategies you can use in 2023 to mitigate the tax burden associated with the Employee Retention Tax Credit. And if you're watching this on YouTube, go ahead and click subscribe. That way it'll pop up in your feed when you, when you go on YouTube. So we have Greg here. Greg, thank you for joining us. You're a national specialty, you're at a national specialty tax consulting firm. And your former big, big four, wasn't it the big eight?
Big eight when I started. I had hair at the same time too, but
wow.
A lot of years have gone by for sure.
I wonder if it'll end up being the big one. I don't know. Who knows? The big two. And then you work closely with other CPAs and you're very specialty in niche. And maybe if you can explain what that means that you're a specialty firm.
Yeah. So we're a tax consulting firm, but our niche is federal and state tax credits and tax incentives. So that's all we do. So we team up and we partner up with CPA firms and CFOs across the country to help them take advantage of these specialty tax credits. Because the majority of local and regional CPA firms out there just don't have the expertise to understand how complex a lot of these credit programs are.
And Jim, that even goes for Marcum. I mean, we do some of that work internally. I mean, we're a large firm, 4,000 people, but we do refer a lot over to Greg because he and his group have a lot of resources and dedicate themselves to this specific area.
Yeah. And, we have a webinar coming up next week, which is assembling your A team. And this is something that if you're not in the tax space as a lawyer, financial advisor, accountant, you might not know that a lot of times there's a lot of people involved in a particular process or a particular tax strategy that the outside world might view them as well. Aren't they competitors? Well, no, we're professionals. We bring in different attributes and different skill sets really to serve the client. And that's really ultimately what it's about. And then of course, Phil, you've got, you and I have, I think now this year is 30 years experience for me. You just put 30 plus, my dad, he retired at 78. He's like, I had 45 years experience. Yeah, I don't think that's a good idea. It's too much. I don't know. But you're a partner at Marcum, which is now a mega national CPA firm. What's your number now
well, we have over 40 US offices. I think we're the 11th or 12th largest firm in the country. We have specialty groups handling all kinds of different things. So from public companies to private equity to specialty lines, we do all kinds of things. We even do get into this area with the ERC. However, we partner with Greg and his firm on a lot of it because, it is a specialized area. And one of the things I wanted to say is, anytime you start hearing a lot of radio ads, that there's abuse going on in that area, and the IRS is auditing and is looking at those. So you want to make sure if you're going to have it done, make sure you've got a good reputable firm and make sure that you do clearly qualify. And that's why we like Greg and his group and why we do things that way at Marcum.
That's great. So I'm a lawyer. I'm a partner at CunninghamLegal. I need to change that to 30, I guess. Maybe I'll leave it at 25. We have offices in Northern and Southern California, and I'm a real estate broker, securities, insurance licensed, and a pilot. These are the lawyers in our firm. We have lawyers in Northern and Southern California. And this is the big disclaimer. This is, they're lawyers and CPAs talking. We're not going to talk, and then you should not rely on this to go out and do a bunch of stuff. You absolutely need to meet with a professional. And if you'd like to meet with one of us, great. If you want to meet with if you got a team that you want to meet with, great. But really don't listen to this and then like, oh, well, they told me to do this. So this is not specific to you. This is information only. So what is the employee retention tax credit? Greg, you're the expert. What is the employee retention tax credit? What is going on here?
Sure, sure. So this is a refundable tax credit that is being administered through the payroll tax system. So a good way to think about this program is it's another form of stimulus to cover wages that weren't paid for by the PPP money. So when you're looking at this program, right, it runs from March 13th of 2020, and it goes through September 30th of 2021. So there's been changes to it. So basically, when this program was first put into the tax law, it was for 2020. And then along, comes the Consolidated Appropriations Act, and then the American Rescue Plan, and then the infrastructure bill. And between all of that, it's changed it. So it was extended to June 30th at one time, and then it went to December 30th, and then it got pulled back to September 30th. So that's the program. And so a way to think about this is it's a credit that is for wages above and beyond the PPP funding, like I mentioned. And what you have to do is first you have to determine if you're eligible. Then once you determine eligibility, then you look to what are your qualified wages. And we can get into that in a little bit. I think we get into that further down. But
yeah. A question somebody has is the employee retention tax credit considered taxable income? I would say technically no, but you can think of it as yes, because what it does is it takes away your deduction in 2020 and 2021. We'll talk about that. The deduction for those qualified wages for which you got this refundable tax credit. So technically it's not taxable, but it effectively is, but it's not.
Right, because you're not deducting those payroll taxes. Yep, Greg will get into that a little more.
Right. So when you're looking at the ERC, right? Again, when you're looking at kind of how do you get $26,000, potentially $26,000 per employee? Right. So the 2020 credit is an annual credit. So it's a 50% credit on a maximum of $10,000 of qualified wages. So your maximum credit is $5,000 per employee, and it's for the whole 2020 year. When they extended the program into 2021, they changed it from an annual credit to a quarterly credit, and then they changed it from a 50% credit to a 70% credit. So if you're eligible for multiple quarters in 2021, you could get up to $7,000 per employee per quarter. And again, first 3 quarters it goes through. So that's how you get to the $26,000. That is if you're eligible for the whole thing, right? And most companies are not going to be eligible for the whole thing. When you're hearing all these ads out on the radio and network cable TV, there's a lot of pop-up consulting firms telling everybody that they're eligible for the whole thing, and it's not the case. So buyer beware.
All right, so it's a 3-step process.
Yeah. So the first thing you got to do is you got to determine if you're an eligible employer. And then once you determine that, then you look at, okay, what are my qualified wages? And then you basically, calculate the credit and complete the form. So let's talk about what is an eligible employer. So how this works is you have to meet one of 2 tests. And so this is or, not an and. The first test is a revenue reduction test. So basically what you're going to do is you're going to look at your calendar quarter gross revenues from 2020, and you're going to compare it back to the same calendar quarter in 2019. And the threshold is greater than 50% reduction in any calendar quarter. So that's a high threshold that, for the 2020 ERC. Now, when it got extended into 2021, as part of the enhancement, they changed that threshold to greater than 20% reduction. So same concept. You're going to look at Q1, 2, and 3 of 21, comparing it back to the same calendar quarter in 2019. If you had a quarter where you experienced a greater than 20% reduction, you're eligible for that quarter, but you also get a subsequent quarter. So once you meet the revenue reduction test in one quarter, you get the subsequent quarter as well. So that's the first test. And that test is very objective. It's black and white. You either check the box or you don't. and it's a safe harbor test. But and then independent of that test is where you get into the more subjective test. And the second test basically says this. It says, in any calendar quarter, did the company experience a partial or full suspension of operations due to a governmental order that limited your ability to conduct commerce, to travel, and to have group meetings? As you can see, that is very subjective. So what do you do there, right? So the process is you start to identify the various governmental orders that are out there, could be any level of government, federal, state, county, or city. And then you look at how did those orders impact your ability to do business, to do commerce. Now, this is where a lot of these pop-up consulting firms are being really aggressive, and they're telling everybody that they're eligible under the second test. But what you have to demonstrate is you have to demonstrate that these governmental orders had more than a nominal impact on your operations. And this is where these other consulting firms really don't get into this whole piece of it to determine eligibility. They're just telling everybody they're eligible. So how the IRS has codified more than nominal is greater than 10%. So in their guidance, so what does that mean? So when you start identifying different segments of your business that may have been impacted by a governmental order, then you have to be able to demonstrate this more than nominal. So, this business segment that was impacted, was it more than 10% of your overall revenue in 2019? That says that segment was a more than nominal of your overall operations. And then you have to demonstrate that segment took more than a nominal negative hit, either in revenues or maybe in employee hours, or the two metrics that the IRS has provided us as guidance. And the IRS's guidance on that is a bit lacking for sure.
Yeah, so this sounds really complicated.
It gets complicated pretty quick when you're looking at this, partial suspension test.
Yeah,
for sure. And that's why you got to know what you're doing, and to make sure you don't put your client or your company in a situation where it gets sideways with the IRS.
Well, this is great. And this is how to reach you. We've got your information here. You're at 760-473-2456. And if you're watching this and you're like, wow, I didn't get this employee retention tax credit, Greg's a great guy to reach out to and to help you with that. So the next question is, who is eligible for the employee retention tax credit? Okay, so there were a series of bills that were passed, and it's been amended several times. There was a CARES Act in March, right after COVID hit. There was the Relief Act of 2021, the American Rescue Plan Act of 2021, and the Infrastructure Investment and Jobs Act. So lots of congressional activity, lots of money crammed into the economy. And this is part of that, the government cramming money into the economy through the employee retention tax credit. So it's essentially a big handout. And as Greg was saying, there's this measurement of, who is eligible. Well, you had to have a significant decline in gross receipts during 2020, or declining gross receipts during the first 3 quarters of 2021, or this sort of suspension of operations. And what about a startup business? Have you done any ERTC for the startup business?
Yeah, we actually have. So they put in this whole other category for, they call it a recovery startup business. So if you, started after February 15th of 2020 and you have under $1 million in revenue, then what happens is you could be eligible for Q3 and Q4 of 2021 only. So it's limited to that. So whenever you're in a project, we look at that, and then you don't have to follow that, right? You can still, because if someone started a business in 2020 and they have the opportunity to generate a bigger credit than just looking at Q3 and Q4 of 2021, we'll look at that. So you look at it both ways and say, how do you maximize the credit?
Yeah, it's sad. You think about the people who started a restaurant in February of 2020, and you're just like, oh my goodness, poor people.
For sure.
Let's see. So again, this declining gross receipts in 2020, it's a 50% decline in any calendar quarter. And in 2021, it's a lower bar, right? I mean, or a higher bar rather, I guess lower. It's 20% decline in any calendar quarter. So it's easier to get money, correct?
Correct. Under that that revenue reduction test. Yeah, they definitely made it easier.
So how would you, I mean, in assessing the impact that COVID had on your business, you're going to have to go back. So if somebody has not applied for this already, right? And here we are, we're in 2023, you're thinking about going back to 2020 and 2021, you have to get all those payroll records, right?
Yeah. So once you determine eligibility, right, then you got to look at, okay, what are my qualified wages, right? So that's where you're going to have to go back and you're going to have to get detailed, payroll records by employee. And then, you're going to need to get copies of your originally filed, 941s, right, the quarterly payroll taxes. But this is how you file for this credit is by amending the quarterly payroll tax returns. And unfortunately, the IRS does not accept electronically filed amended payroll tax returns. So these have to be paper filed via snail mail with the IRS. So it's taken the IRS anywhere from 8 to 12 plus months to process these claims once they're filed. So the money is coming, but it takes a while.
Let's see here. So some examples of the government orders. So we have limited hours of operations. Gosh, this is just bringing back, I think, a collective, PTSD for everyone watching this because we all lived through COVID, right?
Right.
These are, I mean, I think we forget how bad it was, right? People couldn't go to work. People were worried, am I going to get arrested if I go to work? Can I go to the beach? My son went to the beach in LA County and the cop walks, he's the only person on the beach. Cop walks up to him and says, you can't be on the beach. It's like, what are you going to do?
Yeah.
Yeah. There's a lot of other things on here too. I mean, things like supply chain disruptions. I mean, if you were open and you were manufacturing, but you couldn't get your products from your suppliers, I mean, that's something important too. So there's a lot of things that you need to walk through and look at. The other thing that I want to say is you're right. It can take 8 months, 9 months, 12 months, but the IRS is issuing those refunds. We've had a lot of people see and get those refunds. It does take time. I mean, the wheels of the government do grind slowly, but they do move. So it's, you just want to understand that up front, where if someone's telling you, yeah, we get this done right away and you'll have your money in 30 to 60 days, that's just not the case.
Yeah, for sure. As you know, the IRS is, the backlog that they have is huge, and it's taken them time to process these things. It's a manual process that you have to go through. Right, like you said, the money is flowing for sure.
And Greg, do we have a statute coming up? Because everything really started in the middle of March 3 years ago, right? So March of 2020 in the middle. And then the end of March 31st was the end of Q1. Is there a statute that's coming up and going to be expiring just for that very short period?
No. So what happens is it's tied to the filing of the annual payroll tax returns, not the quarterlies. So the 2020 annual payroll tax return was due April 15th of 2021. So 3 years from that date. So April 15th of 2024 is when the 2020 ERC falls off. That's the statute. And then the 2021 goes out to April 15th of 2025.
Okay, so we still have time. People still have time to pull these records together, make contact and get this done, or at least looked at. And the first step would be to analyze it and see if you qualify. Yeah,
first step is determining eligibility, right? In which quarters are you considered an eligible employer? Then that's when you look to, okay, what are my qualified wages? So basically what happens is for small employers, under 100 full-time employees, your qualified wages is going to be gross wages paid to employees plus any employer paid health benefits. However, you can't qualify wages that were paid for by PPP money. You can't qualify wages that maybe went into the other COVID credits, the sick leave credits or the family leave credit, family leave credits. Also, you can't qualify wages of majority owners or any relatives of majority owners that work for the company. So all of those are off the table. But then once you determine the qualified wages, then you calculate the credit at the employee level, right? So again, the 2020 has an annual cap of $10,000 of qualified wages. So it's a 50% credit on up to $10,000. And you calculate it, like I said, employee by employee. And then these are filed by amending the quarterly payroll tax returns. I mean, like I said, they're sent in via snail mail to the IRS Service Center.
Yeah. And I will say, if you're watching this and you're thinking, yeah, I'm a business owner, I haven't done this, I've heard about it, I don't really understand it, it just sounds really complicated, you may be leaving hundreds of thousands of dollars on the table. I mean, I know people who've gotten 800,000 in ERTC, in the employee retention tax credit. And these are big numbers. And these are people who really suffered economically, right? A lot of businesses did really well during COVID and a lot didn't, right? So it seems like that was, you either did really well or you really struggled during COVID. So this is our contact information here. If you'd like to reach out to any one of us, feel free to do that. We can help you. So how do you get the employee retention tax credit? So you have to refile your form 941. That's the the quarterly employment tax returns, right? And these have to be filed, as you said, Greg, these have to be filed snail mail, which means print, sign, put in the US Postal Service. And where do they go? I don't know. They go to somewhere in Utah. Where do they go?
Yeah, depending on where the company's located, but yeah, most West Coast are going to file with the Utah Service Center.
And I would say, this is lots and lots of detail that can somebody's just regular old CPA do this? What are your thoughts on that?
They can if you're eligible under the revenue reduction test, the safe harbor. Local CPAs, some of them feel comfortable with doing those types of projects, but many of them haven't dug deep enough into, all right, when you get to the calculation part of it, how do you take into consideration the PPP money, right? How does that interplay look? And what's your methodology of how do you allocate that money down to the employee level? Because you have to allocate that PPP money down to the employee level in order to calculate the credit. And there's definitely some things you can do to maximize the benefit. So even if the CPA does it, doesn't mean that they still could leave some money on the table because they don't understand the crux of how you can maximize.
Yeah, I mean, it's really interesting you say that, because I think there is and this is kind of goes to part of like assembling your A team. Many times CPAs will what I get from clients is a CPA will tell the person who comes to me, you need to find a new CPA because you're my biggest client and you need more than the CPA is either prepared to do or willing to do or whatever it is, or maybe it's a training. But I will say, if you're watching this and this sounds like a bunch of foreign language to you, this is why you need to have an A team, because we all have the same amount of time in a day. I mean, Jeff Bezos, one of the richest guys in the world, has the same amount of time that we do. And look, he created Amazon. It's incredible, right? So I think one of the aspects of being a business owner and one of the aspects of looking at these tax structures is you really need to leverage your time and you need to involve other professionals and you need to get your A team involved to really take care of that, because ultimately you end up with more money, and that's a net positive. So, you have to file an amended 941X for each quarter, correct? So that would be 7 returns or 8 returns potentially.
Yeah, if somebody's eligible for the whole period, yeah, that's going to be you're looking at 6 to 7.
6 or 7,
quarters. Yeah.
So it's a lot. I mean, it's a lot of paperwork, and it's literally paperwork.
And Jim, I'd like to highlight most CPAs aren't in the business of preparing payroll tax returns. That's why you have ADP. That's why you have Paychecks. That's why you have Workday, right? I mean, those payroll services can do it a lot more efficiently. So that's probably where it was done initially. I mean, Greg, are a lot of the companies that you review and look at and do, were they using one of the large payroll services?
Oh yeah, ADP, like you said, Paychecks, Gusto. I mean, you name it. I've seen it all. QuickBooks. Most use that. And then there are companies that may use a PEO, like a TriNet or Insperity, right? So doesn't mean, if you're using them, right, because that's co-employment. So the payroll tax returns are filed under their FEIN. So if your company is with a PEO, then you have to provide the ERC information to them, and they have to file on your behalf. and then they give the money back to you. So that it gets a little bit more complicated when you're with a PEO, but it doesn't mean that you shouldn't do it. You still should go do it for sure.
And you can assist with all of that, right? Reviewing that data and
yeah, we still do. Yeah, we have filed a lot of claims with PEOs, right? And where we do all the work, and then we got each PEO wants to see the information in a different format. They have their own formats, and then they all have their different schedules of when they're going to file the quarterly returns. But what they're trying to do is accumulate as many of their clients' ERC claims, and so that they do multiple companies at a time. Instead of because they have to file their 941s are huge, they're massive.
Right.
Yeah, Greg, I have a question. So if somebody's using a big national payroll service company and they say, oh yeah, they can handle that for me, is that enough? Or might they be leaving money on the table? How deep is not to use a name, but how deep are these national payroll services companies? How deep do they go in terms of the analytics? And is it a question, are they overstating what it should be, or are they understating, or are they getting it right? I mean, what have you seen?
It's been all over the board. A lot of them will say they always put the determining eligibility back on the company, right? They're like, you tell me you're eligible, and then I can file it for you, but they're not taking any responsibility on the eligibility.
Yeah, that's where that's exactly where I was going with that. Is it's like, well, you tell me, okay, well, how do I know? Like, I make widgets. I'm not a tax lawyer or at a CPA. I mean, it's tough, right? And that's why you need your A team, right? That's why you need this group of people. So you need to determine if you're eligible. You need to understand and explain the scope of the government offer to cover your payroll through credits. This is a big thing that you do, and develop the qualifying wages, and then monetize the credits through payroll. So you do this 941, you submit it, you get a check back from the government, and however long it takes, months, years, who knows, right? What are you seeing as the turnaround time now for amended 941s that you're filing?
It's all over the board. We tell our clients it's going to be 8 to 12 months, if not longer. But every now and then you'll see a small claim come through, in 6 months. But there's just no rhyme or reason to the timing by the IRS.
Yeah, and that's really hard because the IRS did tell everyone, hey, if you're going to claim this for 2020 and 2021, you need to not deduct, right, this tax credit that you would otherwise be getting, but then you have to pay the taxes and you don't have the money for the credit, right? You see where I'm going with that? And so you kind of had to overpay your taxes.
And we've had that, right?
Yeah.
And it's painful because, right, you've got to go ahead and not take the deduction. So Greg, maybe you can walk through exactly what we're not deducting, but you're not taking the deduction. So you're paying more tax now, and then you're waiting to get that money back. Now you're getting back a lot more than the tax that you're paying now. So that's something we should walk through also.
Right, because so basically, right, you're looking at 2020 and 2021, and this credit is based on the wages that you pay to your employees in those tax years. So what the IRS is saying is you're losing that tax deduction for the amount of the credit. Right. So you have to go back and reduce your payroll deduction, for the tax year that generated that credit. So that will, so yeah, you have to amend your income tax returns, and that's, like you said, Jim, that's going to create additional tax.
Yeah, the net effect, even though it's not taxable, it's taking away a prior deduction that you really, and we'll talk about this. Can you do income tax planning for 20 and 21? It's kind of a tall order. Anonymous asks, is there a difference in the maximum amount available to claim on a quarterly employee wages between 2020 and 2021? So it looks like here in this slide, it looks like for 2020, the maximum was $5,000 per employee annually, right?
Annually, correct.
And it's $7,000 per quarter in 21 for 3 quarters, not 4.
For 3 quarters. That's correct.
So hopefully that answers the question. I think it does. And then these are some example numbers here that you provided that Think LLPs provided, and these are pretty substantial numbers. I mean, these are 37 employees, a $175,000 tax credit for 2020. It's a lot of money, right?
Yeah.
It's a company.
Yeah. And again, this goes across all industries, right? So I mean, it doesn't matter what industry you're in, you should be looking at this to determine if you're eligible or not. So we've done it for just about every type of company out there.
But not cannabis, right? Forget it. All right. That's an exception.
Yeah.
All right. So we've got our information here if you'd like to reach out to us, Greg and Phil and myself. So let's talk about tax mitigation strategies in 2023 to reduce the tax bite of your federal income tax related to the ERTC. Now, I wrote this and this is as short as I could make it, because what's happening is if you get this ERTC, you have to amend your returns, which decreases your deduction in prior years, which results in more tax. If you amend your returns for 2020 and 2021, and you do that in 2023, and you owe tax, that money has to come from somewhere. It's going to come from your pocket in 2023. It's not just going to magically appear from the past. You're going to have to pay it. So even though, and we talked about this, even though it's not taxable when it's received, the wages equal to the ERTC are subject to your expense disallowance rules. And Phil, explain what the expense disallowance rule means.
Well, it much like people were asking, does that mean I have to then increase my income and pay more tax? You're really just reducing, and that was the 5,000 and the 7,000 on the prior slides, right? So now you're not getting that deduction. So when we saw the amount that was being refunded, so let's take a number, Greg, there was one on there that was 770,000 between the 2 years on one of your customers that you actually did it for. That means that they're going to have to pay the tax on 770,000, right?
Federal only though, right?
What's that?
Yeah.
Federal only, not state.
Yes. This is a federal concept. So for state, we don't do anything, right? But we're not getting any refund for the state either, because the state doesn't have this program. This is really only for federal tax. So we now are getting 770,000. We're going to be getting that back, but we need to amend and pay the tax on that 770,000, which, could be roughly a third. It just depends on your tax bracket, right? So you're going to pay the tax on that amount. So that's, and that's painful. But Greg, I don't think there's any interest or penalties. Isn't there a provision where those were waived? So normally when I go back and I amend a return and I pay additional tax, the IRS now wants interest and penalties.
Yeah, for this, there's not going to be any type of penalty or interest that's going to be due. It's just going to be the tax related to the the disallowance of the deduction.
Right. So you're essentially trading. You're getting two. Let's use an easy number. Let's use 900,000. If I'm getting 900,000 back, and the highest marginal percentage is 37%, but let's just use a third. That's roughly $300,000 of tax that you're going to pay, but you're going to get 900,000 back in 8 to 12 months. So it's a timing issue, but the money does have to come from somewhere.
Right. And what's the deadline? If there's no interest and no penalty, can I just file it when I'm like 95?
Well, that's probably a best practices. I mean,
well, no, but no, it's because when I was researching for this, I couldn't find the answer.
Well, there's two things. So number one, you've got the statute of limitations. So as Greg was saying earlier, that's bound by the company's year end, right? And when it has to file its annual payroll tax return. So that's item number one. So you've got your statute of limitations, right? Your 3-year statute. But the other thing is best practices would be you do it at the same time, because if they're ever going to match it or look at anything like that, you want to make sure that it all gets done. So
yeah, so what you're saying is that's for the people who haven't done the ERTC, who haven't amended their 941. What about the people who have amended their 941? They have gotten their checks. but they have not yet amended their returns for 2020 and 2021. How long does that person have? Has the IRS said that it has to be a certain date?
Well, yeah, they have to do it within the statute of limitations. So our recommendation would be do it as soon as possible. If you've already gotten your refund for your ERC, you need to, I mean, now you've doubled up. So yes, don't do that. The IRS frowns on that.
So here's a question, and this is another common question. Instead of removing the deduction and amending your 2020 return, can you simply pay the tax for the refund in the year received in 2023?
That's not what the law says to do. So no. And Greg, I think you would agree with me on that.
Yeah, I mean, the IRS's guidance on it is pretty clear. You have to amend the tax year that generated the credit. Even if you're a cash basis taxpayer, it doesn't matter.
So what if you amend your tax return for what if it's been more than 3 years? We're not there yet, but let's assume hypothetically it's more than 3 years since you filed your 2020 tax return. Can you go back and amend?
Well, that would be a problem because technically the IRS can't accept an amended return. But if they're ever going to pull and look at your amended payroll tax returns that you did, you're really whipsawing the government.
Yeah.
And at that point, if they're auditing it, they would disallow your ERC refund.
And make you give it back?
Make you give it back because because if that statute is open, but the other year is not, that's a problem. Our advice is make sure you do it at the same time. If you haven't done it, get it done and get that amended return done for the company.
I tell, people have a spectrum of views on, I will put government workers into a bucket. And if you're a government worker, I'm not saying this in an offensive manner. I will tell you the people that work at the IRS are some of the smartest people I've ever talked to. They're a bunch of like Boy Scouts that are super smart. It may take a long time, right? But it's kind of like the FBI says, we'll always get our man or woman, I guess now. So Phil, you're absolutely right. Greg, you're absolutely right. If you're watching this and like, yeah, I think I can game the system. No, because there was so much money that went out. No.
And there's a word for that, and we don't like to use it, but you're really committing fraud. So we don't, there's no reason to do that. Do things the right way.
Yeah.
And that's why we're here and why we do things the right way.
All right. So let's say you've gotten your credit and now you have to pay, now you got to amend your taxes and you're like, oh, I got to come up with this money. Is it really feasible to reach back into 2020 and 2021, Phil? Does that make sense for most taxpayers or not? I mean, or is it case by case?
No, it really doesn't. I mean, there may be some provisions. I know that on solar, you can now do a carryback for several years on your credits that you're generating out of commercial solar, but generally not. There's not a way to do that.
Yeah. So what this is I think this is a shift in mindset. And this is something that Phil and Greg and I were talking before the webinar is a lot of people have, I would say, certainly if you're a business owner or you're a wealthy individual, you need to have a multi-year mindset when it comes to taxes. Taxes are reported annually. So you have a 1040 for 2022. But when we do tax planning, when Phil and Greg and I do tax planning, we are looking on really the arc of time over a span of years, because some of the strategies and some of the habits and some of the practices, they really do have a much longer time horizon in terms of their overall return. So with that in mind, if you say, well, if I can't do anything for my 2020 and my 2021 taxes, how do I deal with this? Well, what you do is you think about, what are some tax reduction strategies I can do in 2023? Like, let's assume you're still making money and it's 2023 and now you're going to have to pay a lot more in taxes than you thought you were going to have to pay. What are some of the strategies that you can use? And I would really encourage you to check out our YouTube page, and we'll have some links in our YouTube. If you're watching this on YouTube, it'll be in the notes. But there are a lot of webinars I've done, and Phil, you're on several of these, of just methodologies and ways of thinking. And it's not necessarily like, hey, watch this and go do it. It's not a do-it-yourself project, but it really is opening your eyes to this whole universe of all these strategies that, frankly, wealthy people use and not so wealthy people use, okay, to mitigate their overall taxes. And we're going to cover, and so there's a lot of these that are in our YouTube. So if you're looking at this, I've just put a laundry list to show you. Please go to our YouTube page. It's under the tax section, and we'll have some links in the show notes. But I do want to finish it out by talking about some of the tax mitigation strategies. So there are three concepts in taxation. There's a tax credit. Now, a tax credit is dollar for dollar. What that means is if I get a tax credit of $1 and I owe the IRS $1, I can take that credit and give it to the IRS and extinguish my $1 in liability. In the hierarchy of things that are good when it comes to taxes and tax planning, credits are at the top, right? Because it's dollar for dollar. You put $1 in the machine, you pay $1 less in tax. The next one is a deduction, okay? Now, what this means is a tax credit is dollar for dollar against the tax bill. A deduction of $1 might offset your tax bill 37 cents. So it is removing from your taxable income. And I know for a lot of you, this is Captain Obvious stuff, but it's really important to understand the difference between a credit and a deduction. So if I deduct $100,000 from my income, I'm paying $37,000 less in federal tax versus a tax credit of $100,000. That means I am paying $100,000 less in tax. And then the other one is the tax deferral strategy, which is pay later. I'm going to take a deduction this year, but it comes back down the road, right? It comes back, those cows come home, and then I'm simply deferring the tax. So I do want to talk about a couple of things. I do want to talk about cost segregation because I know you guys are both in that space. This is for people if you own residential rental property or commercial or industrial property, you can change the method of accounting. So maybe, I don't know, Phil or Greg, if you want to talk about how cost segregation works. So let's say I own a multifamily, I own a 10-unit apartment building, and I've held it for 5 years, and I have to pay back some ERTC. What might I be able to do with that property I've had for 5 years?
So what you could do is you could do a catch-up provision where you're changing your method of accounting on depreciation. And so you're accelerating the personal property. And that could be things like when you're thinking of an apartment, if you have a multifamily apartment building and you're looking at the appliances that are in there, and there's all kinds of different things, there's classes of assets. And so you go in there and there's an engineering study that's done, a cost segregation study, and that's the basis for supporting accelerating some depreciation, changing that method of accounting and doing a catch up and being able to deduct that against your income coming out of all of your real estate. So it's something to look at. A lot of our clients do that. A lot of our clients are real estate professionals. They own a lot of real estate. That's what they do. They're in that. And so that's something that can be very beneficial for them, because as a real estate professional, you're able to go ahead and deduct that against other income. If you're not a real estate professional and you don't meet the rules, you can't do that, but at least you can offset the income coming out of your real estate.
Yeah, and another thing people can use is a charitable trust. So if you're going to, basically it's moving money from one bucket to another. If you have a lot of appreciated stock, and we cover this on a lot of webinars, you can move that money from one pot to another that generates an income tax deduction, okay? And the benefit of that is that gives you a deduction from your current income that might free up some money you would have otherwise paid in tax to cover that tax bill on the employee retention tax credit. So again, it's a slightly different way of looking at it. Loss harvesting, kind of a no-brainer, right? If you have individual stocks or securities that have gone down in value, maybe you bought high and now it's setting low. You can take some lost harvesting. Now there's some limitations on that. But that's always something to look at. And is that a $3,000? That's a very small limitation if you're not active.
Well, but let's say I'm selling a piece of real estate and I've got $1 million gain on that real estate, but yet my portfolio has declined substantially over the last year, which many of our portfolios have. You could, talk with your investment advisor, harvest those losses on those stocks, get that capital loss in there and offset that capital gain or a good part of it. So that's something that's a good strategy to always look at.
And then we've looked at, so we've done a lot on solar in the past, Phil, and the solar we're talking about is, if you go to IKEA and they're building out, I use this example because I go to IKEA to get, I don't know, the Swedish meatballs, like truth be told, I don't go there to buy furniture. I just like the cafeteria style food. It's kind of cool. So they're putting in these big solar arrays, right? I don't think IKEA is buying that and putting it in. It's wealthy families. The property owner's not doing it. It's wealthy families that are coming in, wealthy individuals, and they might put up a $5 or $10 million or $1 million solar project, and they're going to get some income off of that. Maybe, Phil, if you can discuss some of the tax credits that are available on that.
Yeah, we do a lot in that area, and I know we've had a couple of webinars with you, Jim, on that. But these are commercial solar. It's not solar that's on your home, but it's a commercial project. And it could be something like at IKEA. It could be on a nonprofit, such a church or a school. But what it does is it really locks in the electricity cost at a lower rate for whoever is using it. So whoever the off taker is that's using it, whether it's IKEA, a church, a school, etc., they lock in with the developer, and then the developer says, great, and then sells that off to an investor who can get the benefit of the depreciation expense and also the credits. And the credits have now gone up. They've now increased. The base is 30%. But there's ways that the credit could be 40%, 50%, or even 60%. It just depends on what areas they're in. If it's the made in America and it's assembled here, so there's all kinds of things there. But solar could be 40%. That's a good rule of thumb that we use.
Yeah, plus depreciation. So really, if you think about this, so if you invest in one of these solar projects, they're all different. It's kind of like saying, how much return do you get on an apartment building? So hypothetically, you know, if you put $1 million in and you're getting a 5% return, you're getting $50,000 a year back. You might be getting a $400,000 tax credit plus depreciation. And there's a little bit of a math formula you have, but your net at risk, your net investment at risk might be generating, I don't know, a 25% return on your money when you net it all out, right?
Right. And it really depends on that. We have a lot of different projects that are out there. And so that's something that if you're interested in that, we have that available. One of the other credits you don't list here, research and development credit for companies, because a lot of this is geared toward companies, corporations. To the extent you're doing research and experimental, I know, Greg, your group gets into that as well. And we have a big R&D group at Marcum, but that could be very beneficial. So that it's a very complicated area. There were some new rules now about you have to capitalize some of the research expenditures. So it's a complicating area, but that's something that we do as well as Greg.
And I know you gave the example in the movie, the founder, that was the McDonald's, the Ray Kroc thing where he got up on the ladder and figured out how to design. That's an
more efficient. It's a process, right? It doesn't have to be just people in white lab coats inventing new drugs and things like that. It can be improving processes. It can be installing your ERP system if you're doing a new comprehensive computer system. Anything like that can qualify. Greg, any comments that you have on that?
Yeah, I mean, especially when you're looking at manufacturing companies, right? I mean, there isn't a manufacturing company out there that isn't trying to figure out how do they make your products better, faster, lighter, and cheaper. I mean, that's all, you know, product development, product improvement. I mean, that's all, you know, research and development.
And construction is another industry also. We have a lot of our construction clients. I mean, a lot of what they do, it's all custom. Right. So they all have they have to figure that out. They have to do tooling. They have to do that. So a lot of the design is all custom, and that falls under those R&D eligible credit items.
And what about qualified opportunity zones and qualified opportunity funds, Phil? What is that?
And those are out there. The only thing that I would caution is you always want to look at what the underlying investment is. So you've sold your building, or you've sold your company or your asset. And everyone thinks tax deferral, I don't want to pay the tax, and I have the opportunity to exclude part of it down the line. But you really need to take a hard look of what am I moving the money into? I sold it out of something where I had a nice profit. What am I moving it into? You always want to look at the quality of the underlying investment you're making.
And then the film and motion picture deduction, the Section 181.
That's again a federal only concept, much like ERC. And that gives you the ability, there's special provisions where the film industry has gotten benefits, and you can invest that. You have to actively participate, much like real estate or much like solar, but that's something that is applicable to that we get into.
Great. All right. Well, thank you very much, gentlemen, Greg and Phil, and we've got Elias. Now, you're not part of the Bob's Big Boy people, are you, Greg? Probably.
No, unfortunately
Elias,
not.
brother. Yeah, probably wouldn't be doing this, right?
Yeah, exactly.
And we have offices in Northern and Southern California. You can see the Golden Gate Bridge and some, I don't know where that is. Malibu.
Very nice, Jim.
Yeah, see, we represent NorCal and SoCal, Dodgers and Giants.
Right. Oh, Jim, one thing
Yeah.
I wanted to mention, because a lot of our client base is, you know, for all three of us, I mean, Marcum's nationwide, but, you know, we have 4 offices in California. Just so you knew, California, you remember the federal, with the disaster areas here in California, the IRS listed not every county, but most of the counties where people live. They extended the filing due dates out to October 16th. Governor Newsom's office just conformed to that for California.
Oh, great.
Came out while we were on the call. So California conforms. Consult your tax advisor about what that means, but it could mean that you have until October to pay your estimates, pay the tax from last year, and also file the returns.
Wow. So that's yet another benefit of a lot of rain and snow.
Yeah, it was. Yeah, I don't know what it was like in Northern California, but in Southern California, there was a lot of snow, a lot of rain, a lot of slides, etc. So
We're used to it though.
yes.
All right. So next week, protect your wealth, the secrets of assembling your A team of advisors. And Phil is a frequent flyer on many of our A teams with clients. And I will tell you that if you don't have an A team, we have an A team, just add water. Well, just add money and you have your A team, but you can certainly, if you don't have an A team, we can certainly help you assemble an A team to really maximize the, you know, keep more of what you're earning, keep more for your family, and reduce the overall tax bite. In California, it's very, very important to pay attention to that because taxes are really high. So we've had some questions. I'll leave it here for a few minutes. I'll open it up for any further questions, but I want to thank you for watching this and spending some time with us. And Phil, thank you. And Greg, thank you for joining us here today. I'll let you get back to skiing because I know you're in Mammoth, Greg. So
Yeah.
All right.
It's a bluebird ski day today.
All right. Beautiful. All right. So
Yeah.
if you're watching this on YouTube, just keep watching because another video is going to pop up. Thanks.